Yeah, welcome to session number 2. We have 3 panelists on the program who will be speaking about inflation and asset prices in the long run. I'll be moderating the session. My name is Motohiro Yogo. I'm a professor of economics here in Princeton Economics. And our 3 panelists today, first speaker will be Carolyn Pfluger from University of Chicago, who's an expert on bond markets, inflation, macro finance. The second speaker with us from the Kiel Institute and Sciences Po is Moritz Schlarek. He's a global expert on macro finance, international finance, as well as household finance. And we have my good friend, co-author, and star economist, Xavier Gabex from Harvard, who will be also speaking about the topic. So thank you very much for your attention. We'll give each speaker 20 minutes to speak, and we'll take questions from the audience after that.
Thank you so much for including me in this exciting conference. I've already learned a lot. So I want to talk about inflation, asset prices, one paper in particular, back to the 1980s or not, the drivers of inflation and real risks in treasury bonds. But I also want to talk about this in terms of a little bit my broader research agenda, which, since my dissertation, where the title was Inflation and Asset Prices. So I think, this one paper, but also a little bit more broadly. So here I want to start with inflation, bond yields in the 1950s. I know in the context of this conference, maybe this wouldn't be considered long run. Maybe this is more medium run if we only go back to 1950. But the point that I want to get across here is that this is a 10-year treasury yield, government treasury yield. It went up in the 1980s, went down afterwards. And at the same time, we saw that a slowly moving average of inflation basically followed the same pattern. So that gives you an intuitive connection that when investors expect higher inflation, if they expect 10% inflation, they expect 10% compensation for holding something that pays out in dollars, plus whatever the real rate is. Now the connection with the stock market, and this is here Shiller's CAPE ratio, cyclically adjusted price earnings ratio, is much less clear. If you look at it during the 1980s here, looks kind of like a negative correlation. The stock market did badly as inflation went up. But then if you look here more recently, that's not really quite so clear. So there really seems to be a change. Maybe inflation was even good in the 2000s, good for stocks. One way of teasing that out is computing something like a time-varying correlation between returns on the stock market and returns in the bond market. To be precise, this is not a correlation here. This is a beta, which is, if you think back to your investments 101, is what should determine the risk premium in one of the simplest models. How much of a risk premium you should require for holding this particular asset, in this case, a bond. And what we see here is, I think, really quite striking, which is that this 10-year treasury bond here had a beta of up to 0.5, even higher, for a long time. So this was a risky asset. This was a period when people talked about the inflation risk premium in bonds. And then around 2000, this completely flipped, and nominal bond betas became negative. This was, of course, also the period when we started talking about flight to safety and nominal treasury bonds being the safe haven asset. So the risk properties of bonds really have changed. Now, is that all? Of course, you might wonder how much of that is really inflation. Fortunately for us, governments around the world have started issuing these inflation index bonds, which just think of it most simply as a bond that when inflation goes up, its real value is unaffected. And when I do this exercise for inflation index bonds, you see some movement, of course, but a big gap here. The gap between the red and the blue is what I think of as the risk related to inflation. And in one of my papers with John Campbell and Luis Becerra, we have looked at this change in bond betas. And we have argued that this positive bond beta prior to 2000 was a reflection of stagflation risk. Now, maybe 5 years ago, I would have had to explain what stagflation is. I assume everybody now knows. Stagflation just means, for me, is really the worst case scenario. It's not just high inflation, but also high unemployment, deep recession for an extended period of time. And if that happens, high inflation is bad for bonds, recession is bad for stocks, so bonds and stocks move up and down together. That's what you saw in the 80s. And then in the 2000s, this changed because the shocks were more of a demand nature. So when demand is high, that drives up inflation, but it's the good type of inflation. It's good for the stock market. So bonds might fall because inflation is going up, but really it's a good economy. And so the stock market is doing the opposite movement. So yeah, so that's the story that we told in that paper. We looked at it in a structural model, somewhat structural, because we didn't quite drill down to shocks in monetary policy. The inflation process that we looked at was just what I described. Either inflation goes up in good times or it goes up in bad times. Now, if you're thinking about what's going on and you would like to know, what's good policy, I think you really need to go take a step further and at least speak to the discussion of supply versus demand shocks. What's the role of monetary policy? And that's what this new paper is about. So I think that's really the interesting aspect. Yeah, just in terms of, recently, of course, I don't need to remind you, I had this huge spike in inflation. It's coming down now. Some people would argue, at least sometimes in the press, it said, maybe it was kind of surprising that we didn't get a deep recession. What I want to ask here is, what do bonds and stocks price? And what did they price, especially in this respect? It looks like, at least at this point, we have not gotten a stagflation. Is that something that would have been reflected in bond and stock markets? Now, the big suspects here are, of course, and this is, just some, you can find lots and lots of these quote citations. This is D. Shaw, Wall Street Journal. It's, either people talk about shocks when they talk about bond risks, supply shocks, demand shocks, or they talk about monetary policy. I want to argue that both matter, but the interaction is quite interesting. So the way I want to look at this, and my apologies for those who don't want the equations, forget about it, that's totally fine. For those who want them, I just want to put this up here as to say I want to think about this in the really smallest scale standard model that people tend to think about monetary policy. So here, this is a demand shock. A positive demand shock drive up output and consumption at a given interest rate. So whatever the interest rate is, consumption ends up being higher than it otherwise would. A supply shock here drives up inflation at a given level of economic activity. And then monetary policy follows a sort of rule with weights on output and inflation. So this gamma pi here, for example, tells you that if inflation goes up by 2 percentage points, does the Fed eventually raise interest rates by 2 percentage points, or maybe twice as much? So that's this kind of monetary policy hawkishness coefficient. In order to talk to asset prices, and there are a lot of puzzles connecting the macroeconomy and asset prices. We can't just take something that's super off the shelf, because you would end up with stock return volatility of 2%, which just doesn't correspond to reality in any way. So what I add to that is what I think in principle, conceptually, is really quite simple, which is that risk aversion or risk-bearing capacity moves around. And in particular, investors, when something bad happens, they're less willing to hold risky stuff. So if you get scared, if you experience a decline in your consumption, you're just not as willing to pay as much for risky stocks, and you're willing to pay more for insurance. And I've played around, I've worked a lot on these preferences. I think they have a couple of nice features. In particular, they're quite good at explaining the large stock response to monetary policy surprises, the empirical puzzle that Ben kind of gifted to us as a profession many years ago. And they're also quite good at explaining volatile, high, and predictable stock returns as in the data. So that's my way of connecting the macroeconomy to asset prices here. But I take it different from Campbell and Cochrane. I take it to bonds also. Now, so then I fit this model to macro data from the 1980s, macro data from the 2000s. 1980s, of course, contain stagflations. The 2000s do not. And then I can, the nice thing about having a model is you can run counterfactuals. You can say, what if different shocks come along? What if different monetary policy comes along? And what I see here is the model for the 1980s does generate these very risky nominal bonds similar to the data. Now, what if I change the shocks more towards the 2000s, so more towards demand shocks? The risk disappears. What if I change the monetary policy rule more towards the 2000s, so towards a more inertial rule, more slowly moving, less inflation rate? The risk also disappears. So it's actually, there are different ways to make it disappear here. On the other hand, if I start from the 2000s baseline, negative nominal bond beta, negative real bond beta, so nominal bonds are hedges, they're an insurance, there's flight to safety. Now, if I change the shocks towards the 1980s, so I introduce supply shocks, not all that much happens. You see the real bond beta, the orange bar goes up a bit. If I keep the shocks the same, change the monetary policy rule, not that much happens either. Interesting. So what does it mean? It means that the positive bond stock betas, the inflation risk premium, the inflation risk in nominal bonds of the 1980s, actually requires quite a few things. It requires the volatile supply shocks and a hawkish monetary policy in this model. Now, what's the mechanism here? What's the mechanism here? So Bernanke, Gertler, and Watson, you had this very nice Brookings paper way back when, saying that oil shocks cause a recession, but only if the Fed reacts strongly. And it's basically the same mechanism here. If the Fed, if there's a supply shock, inflation goes up, and the Fed reacts very strongly, while the real rate goes up, that can cause a recession. So then there you have it, high inflation and a recession. Bonds and stocks move together. What's different here and what's new here is that I can say how this is priced in bonds and stocks, which is, of course, something that we can read off the data fairly easily. Here I can also do a further decomposition because we have data on nominal and real bonds. So what if we only have demand shocks? And so this is a plot of, these are the nominal bond betas in blue, real bond betas in red. This is demand shocks in the background, and now increase this inflation rate of the monetary policy rule. Basically, we see that the real bond betas are negative. The nominal bond betas are also negative. If instead I have introduced supply shocks, the real bond betas end up being positive, and the nominal bond betas are very much increasing in this inflation rate. So the real bond betas can tell you something about the nature of shocks. The nominal bond betas, conditional on supply shocks, are very dependent on the monetary policy rule. So those are and I will say one more thing, and this comes from the time varying risk aversion. What these bond betas tell you about in my model is not about the most recent shock. They're not going to tell you was the last shock a supply shock. Instead, they determine, instead they reflect, do investors price these assets as risky in equilibrium or as safe? And that means, for example, depending on the equilibrium that you're in, say you're in the 1980s equilibrium, bonds are risky. Now a demand shock comes along and everyone becomes less risk averse. Stocks go up, but bonds fall because you think of them as, look, they have a beta of 0.5, you know, I become more risk averse, I don't want to hold them either, or I don't want to hold them at the same price. So this tells you it's really a forward-looking measure. So that's what the asset pricing really gives us here. And I think that's a useful thing to, to keep in mind to interpret the data, but also, you know, we do like forward-looking measures in principle. We want to know what do investors price into bonds and stocks. Okay, let's have a quick look back at the recent experience. The red line here is the pandemic. What I see here is that after the pandemic, the stock market and break-even, which is the difference between nominal and real yields, moved together to a pretty strong degree. And that's going to push the nominal bond stock return beta negative during that period. For real bond yields, actually there was, prior to the pandemic, I didn't see much of a co-movement. Afterwards, there was a fairly strong co-movement. And I think that also connects to some of Annette's work, who has argued that movements in the real rate have been quite important for explaining movements in the stock market at that time. Now that's going to give you positive real bond beta. If I combine this into a bond beta from daily data, for this post-pandemic period until the peak of inflation, the blue line, which is the real bond stock beta, went somewhat positive. The nominal bond beta mostly stayed negative. And I can use my model as a framework to interpret that. And what that tells me is that this looks most like a world with supply shocks, but also a soft landing priced in. So it looks like when I'm ever the pessimist. I'm German. I hate inflation. So when I looked at this, I was very surprised and nervous and thought, markets are pricing in supply shocks and a soft landing. You know what? That's what the data tells me. I'll just take it as what it is. But we might have been right. And so then most recently, things have changed a little bit, actually. So this is, these bond betas, especially using daily data, they always move around a little bit. So I'll say that as a caveat. But over the past 3 to 6 months, bond betas have gone up a little bit. Now, what does that mean? In my model, most likely this prices in a combination of expected supply shocks and a much stronger monetary policy response. But does that mean that we're necessarily going to have a stagflation? No, because we also need to have a realized adverse supply shock in addition for that to happen. And I don't think we've seen that yet. All right, so I'll conclude here. I think nominal bonds are super interesting because they fall with inflation. Stocks move with the economy. So this combination, I think, is something that I'm really intrigued by. The positive nominal bond stock betas in the 1980s arguably priced stagflation risk. And post-pandemic, I've worked on this framework on extracting from real and nominal bond betas information about supply versus demand shocks and monetary policy. And it looks like supply shocks have been priced in for most of that period, together with a changing monetary policy. So I'll stop here. Thanks so much.
Thank you so much. I want to start by also thanking Atif for including me on the program, also saying the combination of top-notch research and public outreach you do here at the Rabinowitz Center is amazing and a real inspiration. So thanks for doing this. And this is also a paper that's a little bit different from the previous ones. This is not a summary of 5 years of high-caliber research. This is more like a first dip paper. So I'm going to present you what we have put together for this conference. We know about inflation surprises and asset returns in its joint work with 2 students from Bonn, Hien Kim and Lorenzo. So, okay, this does not work. Hang on. On. The recent inflation surge, to put this into context, is on the left-hand side for the US and on the right-hand side for the other OECD countries, coincided with declines in negative reactions of both equity and bond markets. Housing markets in the US and a little bit in the rest of the OECD have been less affected or with lag or not at all. And so there was a strong response, negative response of real assets to that inflation surprise. And that's a little bit of a puzzle. We're not the first to point to that puzzle. Real assets should, in theory, under some assumptions, be unaffected by inflation. And there are different explanations out there. What we're going to do in this paper is, this is sort of the background for what we're doing. What we're going to do is we're going to take a real macro historical long-run perspective on the question. So what we have is we have 150 years of data for 18 countries from the macro history database that I hope many of you use. And we bring to the table new data, long-run data on inflation expectations that we can use to construct inflation surprises. The new source is going to be archival from the OECD. So basically, the OECD, that country forecast half-yearly for inflation starting after World War II, starting in the 1960s. We coded them since 1965, so we have about approximately 60 years of inflation expectations and then realized inflation from OECD sources. To really get to the long run, we have to have a little aid here, which is we're going to turn to model-based forecasts. We're going to have a whole series, a whole battery of different inflation forecast models, and we're going to average over those. So we add on historical inflation forecast. We're going to use this data to give you sort of a big picture overview of what we know about the inflation hedging performance of different assets in the long run. So I'm going to show you some inflation betas. I'm going to show you the dynamic responses of different asset returns. I'm going to talk about something that is that Caroline will hopefully like, about demand versus supply-driven inflation shocks, and also talk about the role of monetary policy in shaping the asset return response to inflation surprises. So very briefly, how do we construct these inflation surprises? It's very simple. So we identify unexpected changes in inflation as the difference between the expected and the realized. Inflation expectations come from these OECD country forecasts. We have to make assumptions that these economists at the OECD knew what they were doing, and that this is more or less representative of what the market was expecting. I'm going to show you some statistics, and we think that's probably reasonable. And we're also going to have these time series models as a support for the long run analysis. So these are these OECD archives coverage. I mentioned 65 onwards, half yearly frequency for these 18 countries that we then merge with the macro history data that we have. This is how these OECD economic outlooks look. I mean, some of you might have worked with them. This is for the US, 1976. The first, they bi-yearly, so twice a year, and this is the first one. And you see down here, you have these consumer price forecasts. You also have GDP forecasts. I'll come back to that in a second. This is how these inflation surprises then look since 1965. Here's some big outliers, Portugal, Ireland, Italy. But we have a nice time series for 18 countries for these roughly 60 years. Time series models, nothing big and new here. We use a whole series, a pool of models, univariate, multivariate panel models. I think in total we have 20, and then we use the median forecast of these 20 models, in line with what you can do if you don't actually observe inflation forecast from forecasting sources. We get the distributional model forecast and play around a little bit with those. We'll get there, and then we have the George Schiller macro history data for the real side. This is how these model-based inflation surprises look for 150 years. More interesting maybe is the correlation between, these are the OECD and the model-based over that 60-year period where we have both. And they seem to line up pretty well, obviously. The correlation is not perfect. Asset returns, we have real stock price and total stock returns from the work that Eric and Corthus have done on a half-yearly basis since World War II, and from our own work for the 150-year period. Same for housing, for bonds, where we have total returns on long-term government bonds. So think about these as long-term, roughly 10-year maturity, plus the macro variables that I mentioned. So let's look at start with some very simple event studies. This is just a time series of the frequency of large inflation surprises that we measure in the data. Large is here just greater than 5%. And you see this is the last one where a lot of countries had in the sample actually were confronted with such an inflation surprise. But over time, a lot of this in wartime. In our baseline analysis, the wartime is not included. We can discuss that. Maybe that is an interesting period where you want to know, or maybe this is very special. So we excluded in the baseline. But you see, except for that great moderation period that we all have talked about and for a long time, inflation surprises were not so rare even in the previous times in history. Simple event study setup. We're just going to have lag and lead operators and see how real returns change around these 5% inflation surprise windows. And you get something that many of you in the room have worked on and got something similar. Real equity returns really dropped quite significantly in response to a inflation surprise, 5% here or more, 15% in real terms. Housing less affected, a little wobbly, and government bonds also go down. And as I mentioned earlier, sort of the real assets here still, especially the equity market, still takes a hit. The housing market is a little more protected. So going to the sort of direct correlations leading up to these inflation betas that I mentioned. You see here, these are now the real return correlation between the inflation surprise and the contemporaneous real return. You see equity returns, a really strong negative correlation with inflation surprises. Housing more or less flat in this long. This is now the OECD, these 60 years of where we think we have high quality inflation surprise data. It looks the same. It was very similar for the long run data, and government bonds negatively affected. I'm not going to torture you eyes too much. These are inflation betas, so the OECD surprise level negative for equity, significance depends a little bit on the controls. Housing mostly positive or insignificant, and bonds negative. This is these are excess returns, so nominal returns less short-term nominal interest rates. Very similar pictures. Again, so far nothing too surprising. I think some of you in the room have worked on this. This is pretty much a long-run view on what people with shorter time series have found, and maybe higher frequency, but it's also there in these very long-run and quite comprehensive data. Next step is we want to study the dynamic effects of these inflation surprises. We want to see how they sort of what the longer time horizon is, and we also want to control for observables. We want to control for the state of the economy. We want to control for past inflation surprises. We want to know about the sort of the performance of the equity and the housing market in the past. So we can throw in a lot more controls, and then we're going to run these local projections where we effectively look at the change in log real returns from the year before the inflation surprise, and then project age periods out on a yearly basis, how the returns, how the cumulative deviation evolved. Here is the controls with GDP growth, and we have the real asset prices, inflation, etc. So a bunch of macro observables that quite plausibly might play a role for these reactions, for the inflation hedging ability of it's the wrong one, sorry, of these of the different asset classes. Equity market, housing market, government bond market. You see here cumulatively. In the 5 years after an inflation surprise, I should say this is scaled to a 5 percentage point inflation surprise. So if you want to have a 1%, divide by 5, we get a reduction in the equity return, roughly 30%. Housing again is less affected immediately, but we also see some effect, negative effects down the road, and government bonds immediately affected, and then normalize a little bit more. These are sort of the broad long-run results for the baseline impulse response functions to these inflation surprises. Now what we want to do is want to look at, can do a little bit more on disentangling the effect of these inflation surprises. Whether they're demand or supply driven, and B, depending on the monetary regime, which I think is a particularly relevant category. So we're going to do a little bit of a shortcut here. I mentioned we also have GDP forecasts in the OECD data. So we're going to call something a demand-driven shock, when at the same time that there's a positive inflation surprise, there's also a positive growth surprise. And we're going to call it supply-driven inflation surprise, inflation shock. When inflation goes up at output, the output expectation error is negative. So people who are expecting high output and lower inflation, they get higher inflation and lower output. We call that a supply-driven inflation surprise. And following Caroline's work and others, we would expect equities to have a more positive reaction to demand-driven inflation and negatively affected by supply-driven inflation. This is what we do. So we derive these GDP surprises, and then we measure, we come back to these panel local projections, and we measure the additional effect of a demand-driven inflation surprise. So if we add this interaction term and say, like, this baseline response of equity markets and housing markets and bond markets, how is it shaped by if it's demand-driven as opposed to supply-driven. You get something that looks a little bit is in line with, again, this is this long view from history, a lot of data. You get this effect that demand shocks, so at the same time you have a positive inflation surprise, you also have a growth surprise. Equity markets like that. The response is positive relative to the baseline, but overall still negative. Yeah? But we have a sort of a much less negative response. It looks better. Housing becomes almost flat, and the government bond yields are still negative. I think that makes sense in any case. What about monetary policy? And I think this is where our long-run data is particularly interesting and helpful, because what we can do, we can exploit one feature of economic history, especially international economic history in the long run, namely that a lot of countries ran fixed exchange rate regimes over time. So we can distinguish the effect or the inflation hedging performance of real assets, if you will, depending on whether monetary policy can react, is active or passive. And remember, in a fixed exchange rate regime with the open capital markets, policymakers basically cannot do much because they are bound by the peg. So what we're asking is, does the response of central banks to inflation matter for the asset market response? So one idea out there in the literature, and it goes back to Farmer's 1981 proxy idea, is that let's call it quite weak inflation hedging performance of stocks has to do with the fact that higher inflation basically proxies for bad future economic news. The central bank raises interest rates, growth goes down, real cash flows fall, something like that. Yeah. So we can test that. And by the way, the central bank's reaction to inflation surprises also plays a big role in the recent literature, and some of those papers are mentioned here. So what we're going to do is we're going to just differentiate the asset return response to inflation surprises in fixed and floating exchange rate regimes. And this is the case when pegged countries with an open capital account are subject to such a surprise. And what we find, I think, we think is quite interesting. We see indeed that if you look at the left-hand side at the equity market, the red line is the pegged exchange rate regime under capital mobility. So this is the case where monetary policy is constrained, where policymakers, in response to the inflation surprise, cannot adjust monetary policy. We find that the equity market, the return response in the equity market is much less pronounced. And much sharper in the floating case, in the case where monetary policy can react. Housing, again, same bond market, not a big difference. Can we come up with sort of a more conceptual mechanism why this is the case? Well, one is, as you can see here, indeed in reaction to an inflation surprise, in the floats, short-term interest rates go up. Central banks, on average, react, whereas in the pegs, there's very little reaction. It's not really significant for most of the time. So interest rates, nominal interest rates, stay put. An implication of that is that inflation surprises and that has just some relation here to what Kilian said earlier. In pegged exchange rate regimes and where the central bank does not react to the inflation surprise, we find that inflation surprises are actually expansionary for GDP, whereas they're contractionary for floating exchange rate regimes. Again, the central bank response being likely a key variable. And you see here, this is really talking to Farmer's idea of this, the proxy and the dividend, the real cash flow implications of this. You see that real dividends fall in floating exchange rate regimes, whereas they stay more or less, they fall less, they still fall a little bit, but they stay more or less flat in fixed exchange rate regimes. So the idea that Farmer originally put out, that the inflation hedging performance of stocks is so weak because there is a monetary policy response, it proxies for bad future economic news, given that central banks react, is mirrored here in the sense that where central banks are constrained and their hands are tied, we don't find much of a negative asset market response, and hence a better inflation hedging performance of equities. Let me come to the end. So overall, in this sort of long-run view, we have a mixed inflation hedging performance of real assets across history. Housing, on average, provides some inflation hedge, but it's far from perfect. The negative effect on stock return can be seen over longer periods or some period missing. The source of the inflation matters. Demand and supply-driven inflation lead to low asset returns, but the effect is much less negative for demand-driven inflation shocks if you buy into this identification versus via the parallel or synchronous revisions in growth and inflation. And we do indeed find that the monetary policy regime and likely the response plays a large role for the asset responses where policy is constrained, stocks and housing returns respond significantly less, and that is in line with this Farmer's idea of a proxy effect, that inflation surprises signal future bad news for stock investors. I'll leave it here. Thank you so much for your attention.
Okay, great. Thanks very much for having me. So I'll talk about inelastic markets, I'll define what it is, and some implications for bonds and a little bit inflation. Okay, so talk about macrofinance policy. In particular, imagine for the long time we'll have very, very low inflation and very, very low interest rates. So what are the tools we have? We can't really do that much monetary policy. So we have quantitative easing. And I'll argue that doing quantitative easing on a large scale, including a lot with stocks and mortgage-backed securities, not just treasury bonds, will be very useful. So Ben Bernanke, amongst his many famous statements, has one. Well, the problem with quantitative easing is that we kind of know it works in practice, but we don't really know. It doesn't seem to work in theory. So here I'll propose a theory where it works very systematically. And there will be an integrated view of bonds, stocks, and potential exchange rates and things like that. So I'll start mostly with US stocks, and then I'll generalize just to have just one asset class. And once we understand one way to model that one asset class, we can generalize to stocks and bonds and the link and all that. Okay, so just if you look at the world, markets are extremely volatile, be it stocks and exchange rates and also a bond market. And a common feature across many, many models is that markets are very macroelastic. So in those models, if a sovereign wealth fund bought 10% of the US stock market, essentially it would move not at all the value of US stocks. Whereas in practice, I'll argue it does in a big way. And that view that markets are very macroelastic, which is the same thing as saying that flows in and out of the market have no impact on prices. That has very practical implications that flows in financial markets should not matter. Quantitative easing or tightening doesn't work. Central bank intervention in, for instance, foreign exchange should not matter for prices and for expected return. And we'll argue that's wrong. And in fact, not just sort of in practice that's wrong, but also in theory. And so what's the deep knot of why it doesn't work in theory and in practice is because markets are very macro inelastic. And so flows in and out of say the stock market or any other market have large prices on future returns. Useful to have a name, so we call that the inelastic markets hypothesis. So I have present just a sketch of some elements of that theory, first for stocks, and then I'll generalize to lots of other assets, including bonds. And now there's the issue of why are markets inelastic and what's the flow anyway, which is even conceptually, because for every buyer there's a seller, so maybe there's no flow. But there is an answer. And we have an estimate of the elasticity of a great stock market using a new technique I'll call, Ralph Koijen and I'll mention my co-author, called granular IV. And what you find is, suppose Atif invests $1 of his Princeton paycheck into the stock market. So he's going to make the aggregate value of stocks go up by $5. And likewise, if he sells $1 worth of stocks, he's going to make the stock market fall by $5. So the stock market is this kind of fantastic machine where in some sense you inject $5 in the machine, boom, the value of the machine increases by $5. So that's the reactivity of flows. I'm going to say exactly the same thing if it's expressed in percentages. If you buy 1% of the aggregate stock market, selling bonds, that increases the value of the aggregate stock market by 5%. So it's a kind of 5-to-1 reactivity and symmetric between buys and sells. And we'll have a way to measure those flows that's theory-based. Okay, and I'll argue that in this little overview that this kind of inelastic markets hypothesis offers a systematic way to think about movements in the stock market, but also bond market and potentially other things. And we'll think about if the Fed does quantitative easing for stocks, or maybe for bonds, or maybe a mix of both. What's the impact of bonds and stocks? And there will be a cross impact. More generally, there's a flow between asset class I to asset class J. What's the flow? Basically, you sell $1 in asset class I, you invest the $1 in asset class J. What's the impact on the prices of asset classes I and J and potentially the other asset classes? So it's based on a number of papers. The first one is this paper, the inelastic markets hypothesis, that's still slowly making its way through the journals. There's a methodology that now is just published, granular instrumental variables in the JPE. There's a new paper called Network GIV where you can do the same thing that will be useful across end markets. So you can study causal relationships, like how a flow affects the price throughout, in a connected kind of networky economy. So just a few pictures. Some of you may have seen me present that. I like this picture. So why markets inelastic? Basically, many funds are very constrained, okay? And maybe because of self-imposed reason, or maybe because of some sort of rule of thumb. So that can be viewed as also a rule of thumb by maybe individual investors. So this is in green. This is the equity share of mutual funds. I think the rest is in bonds, okay? And basically, it's around 85% since 1993. It's around 85%, and it's very stable, okay? Even though the stock market are huge, ups and downs, et cetera, et cetera. So it's very much consistent with, in some sense, I'm a mutual fund, I kind of target 85%. And I kind of stick to that, okay? And we look at the concept, we'll soften a little bit that modeling and enrich it a little bit, and we look at the aggregate macro consequences of this kind of behavior. Now you might say, what about hedge funds and agile sectors like that? The problem is just hedge funds are very, very small. They're 5% of the market. And on top of that, in downturns, they actually pull out of the market as opposed to, so they're amplifying the downturns rather than going more into the market, dampening the downturn. The reason just because their investors pull out of those hedge funds. Okay. Okay. So just a few equations. Imagine just the stock market, and then we'll generalize to end markets. So imagine the typical fund. First, let's have an undergraduate model. Imagine the typical fund has a mandate to have always 80% of its value in stocks and 20% in the rest in bonds. And let's say short-term bonds, okay, so riskless bonds. Maybe as a self-imposed mandate. So then you can derive what happens in equilibrium. And what happens in equilibrium is there will be an elasticity of a demand for stocks. So what's an elasticity is if controlling for fundamentals, etc., the price of stocks went up by 1%, then the demand for stocks would fall by zeta times 1%, and zeta is this elasticity. And in that little world where the typical fund holds 80% in stocks, the elasticity must be 0.2, which is 1 minus this 80% in stocks, okay? And so delta Q is the change in log demand, delta P is the change in log price or percentage price. Okay, so let's do market clearing. If there's a flow of F% new money goes into the stock market. So that total quantity must be 0, the number of shares is the same. So delta P, the price adjusts to accommodate the flow. And so the change in the price will be the flow divided by zeta, this elasticity of demand, which here was 0.2. That's the same 0.2 here. So it's 1 over 0.2 is 5. So that's how we get, just from a priori reasoning, that, or calibrated reasoning, if you want, if there's a 1% inflow in the stock market, boom, the price of equities goes up by 5%. Okay. You might say, what about just more generally, and then I'll come to bonds. More generally, suppose you had many periods. The way we stylize the representative investor, you say it has some sort of mandate. Maybe it's a psychological rule of thumb, or some explicit mandate, or some mixture of all that, which is this is the fraction this fund invests in stocks. It must be some average value, let's say 80%, okay? And then it can respond to the risk premium, to deviations of the risk premium, okay? And with some strength, this is this kappa. So the traditional rational model will be kappa is infinite, okay? But here in practice, kappa will be actually very close to 0, consistent with your very inelastic, and you basically target your constant allocation. So this becomes the elasticity, and that's how by calibration you could get, you were getting 0.2, otherwise this will be a small rounding adjustment. And so now, suppose you have that at every period, this kind of rule of thumb by funds, or self-imposed rules by funds. What's the, now in every period there are flows going in and out of the market, etc. Maybe some of them can be expected. So avoid the impact if you clear the market in all periods, okay? And you have a little bit of rational forward-looking behavior via this term, you get the following. And this is in deviation from some sort of rational price. You say the price will not be like normal, the present value of future dividends, or there's that, is going to be a future present value of future dividends plus present value of future flows. Okay? So it's a world where precisely if there's a flow now, and FT is the cumulative flow since some time 0, if basically people have been wanted to buy a lot of stocks, then the price of stock is high, okay? And if they wanted to sell lots of stocks, the flow was negative and the price of stocks was low. Very much in a common sense way, the way a Wall Street trader would think about. But then you get it in, sort of nicely, or at least somewhat rigorously derived model. For more the PhD economists here, here this is naive expectations. It could be expectation under some risk-adjusted expectation. Likewise here, there could be some risk-adjusted expectation, like covariance with expectation times some U prime. So then you get a completely bridge with traditional models. So the traditional models would have this kappa being infinite and risk-adjusted expectation. And so, for instance, in the model that Caroline presented, there's no scope for QE in this kind of everything, all markets follow the Euler equation, etc. Whereas here, there's scope for QE, and you can kind of smoothly tune how close to, Campbell and or Cochrane's view you are versus a more, Wall Street trader where supply and demand are what matter. Okay, so this is for stocks, but exactly the same thing for bonds. So the way, I'm not showing you the analytics, but you can sort of imagine. So the way you would think about Draghi saying, haha, whatever it takes, it would be, so first, what's QE? It would be the central banks are going to buy lots of bonds and makes the price of bonds go up by some, and if it was a permanent shift, it's going to make the price of bonds go up by 1/zeta, zeta being this macro elasticity of the demand for bonds that I'm going to calibrate soon. And if a way you can think about, say, Draghi coming in and saying whatever it takes, you say, look, it's in states of the world where there would be a catastrophe, etc. The central bank will, in those future states of the world, will have a big flow to buy, say, Italian debt. And as a result, the price today of Italian debt is fairly high. Okay, you don't need to have a flow now. You just need to announce the flow in the future in those particular states of the world. So I think just I kind of like thinking about this way, so you can get marginal utility kind of reasoning, but also just supply and demand, and in a way the way what you read in the Financial Times and what your economic model tells you are very consistent, which is nice as opposed to this kind of schizophrenia that you have sometimes if you read the Econometrica. And it looks like nothing like the real world. Anyway. Okay, so empirics. So this was all for calibrated theory, which I like actually. And then now the issue is how can you actually identify this slope? And we developed a strategy, and time permitting, I'll develop it in some detail. But basically, we call that granular instrumental variables. And the idea is, so first in many markets, it's you have big firms that are, and their idiosyncratic shocks affect a lot the aggregate. Actually, Mark has some series of nice papers on that and have some. And so now the idea of a granular IV is it's a general purpose way to do identification. And is you're going to find somehow a way, and we provide guidance on that, to measure those idiosyncratic shocks by large firms or large hedge funds, et cetera, et cetera. And this way you can say, given there was the amount of idiosyncratic demand shocks in that quarter, let's look at the price impact or price change in that same quarter. And if you regress basically the price change on the sum of idiosyncratic shock, you find a slope of around 5, which is this multiplier of 5. And there are lots of robustness checks, and you don't want to know. And in general, it's a general strategy for macro finance, where you could use, suppose you want to know what's the demand elasticity for bottled water. You could imagine, there's some factory producing bottled water that had a great productivity shock, and this way it lowered the price of bottled water for its own corner of the market. And you can look at what the impact of the price of bottled water and the quantity of bottled water after that idiosyncratic, say, productivity shock by this brand, let's say. And this way you can get at the supply elasticity for water and the demand elasticity for water. So it's a very, very general way. So that's part of why I'm mentioning that, not just this paper. Okay, so let's do a little bit of policy. So suppose that was the case. I mean, suppose you believe things at face value. In a world like that, suppose the government bought FG, like government, % of the market and kept it forever in the stock market. What would be the impact on the price? And I'm looking at my timer to make sure I'm behaving correctly. I'm fine. The price will be, if you buy 1% of the market, the price will go up by 5%. So is that crazy? So actually, a number of Asian governments have been doing something very much like that. So it started with Hong Kong during the Soros attack. And now the Bank of Japan, they own about 5% of the stock market. And the Chinese national team, in a way, has worked on that. They own about 6% of stocks. And prima facie, if it was the same elasticity, if you buy 2% of the stock market, the stock market goes up by 12% and 10%. And so that seems like a potentially actually workable policy. Why am I saying that? Because you can do now transpose the exact same theory with minor changes in notations and concepts to bonds. Now, it turns out that from the quantitative easing literature, I'm just citing some of the papers here, the demand for bonds the elasticity of demand is 20 times higher for bonds than for stocks. Okay? And so the elasticity of demand is not like 0.2, it's more 4 actually. Okay? And so it means that the price impact is 20 times lower because the price impact is 1 over the elasticity. So maybe if a government buys $1 worth of long-term bonds against cash, the total value of a long-term bond market goes up by only $0.25 as opposed to $5 if it was for stocks. Okay? Now, what's going on? So that's like the prima facie numbers. Now, what's going on when you think about it? It actually calibrates quite well. The intuitive reason is the following: is because when the Fed does QE, it buys. Okay, so I want to buy some long-term 10-year bond, but I give you cash, which is really a super short-term bond. Now, all mutual funds or bond mutual funds are very happy to exchange long-term bonds against the short-term bonds. That's what they do all the time. So it's very, very elastic. Those two things, short-term bond, long-term bonds, are extremely substitutable, and that's why the elasticity is very, very high, around 4. And you could think more deeply why it should be 4 as opposed to 40 or 0.4. But anyway, so that's why QE for bonds will be much less effective than, say, QE for stocks. Okay? So maybe a message would be do QE for stocks as opposed to QE for bonds. I am I pretend that I'm happily ignorant of all political economic constraints here, just as a matter of pure first principle. Okay, so now you can put all the markets together. If you want, let's just do 2 markets together. And you would say, okay, there's a certain quantity of demand for equities, a quantity of bonds, and there will be a price vector, price of equity, price of bonds. Then under basically the same model I showed you, but with more vectors, the vector quantity of equity, risky bonds, and also implicitly cash, short-term riskless bonds, short-term bonds, will depend on the price change in equities and bonds, and also the risk-free rate, plus a vector flows into bonds, into long-term bonds, into equities. And now the elasticity, it's a matrix of elasticities. Okay, so you have the elasticity I mentioned, 0.2 for stocks, 4 for bonds. And then from theoretical reasoning, we didn't directly verify it, but I'm pretty sure it should work. You have the cross elasticity that here I say 0.15. It's basically a very, very close cousin to that 0.2. It's almost the same thing. And then, so by market clearing, if there's a flow, the price should also be 1 over the elasticity, except the matrix. So here's the matrix of elasticity. So what you get from that? You get that if the Fed were to buy 1% of the stock market does go up by 5%, like I said, but also the bond price, in case you're curious, the value of the aggregate long-term bond market will go up by 0.2%. So there's almost no impact from buying stocks into bonds. Which is not, but is not, the opposite is not true. So if the Fed was to buy 1% of the bond market, bond prices go up by 0.25%. That's the kind of non-zero, but still not that impressive power of QE for bonds. But stocks will go up by pretty big, by almost the same value, 0.2%. Okay. So basically, part of the message is you could do QE for stocks and potentially for mortgage-backed securities and junk bonds and things like that. So I do care about imagining. Suppose you really do that as a general policy. Would that work? So you want to have some theory where the flow come from, and at least the first draft of the paper we were very agnostic about. We tried not to take a stand on that. But we're still thinking about it. So you might say, if policy changes, what will change in all that? So we have some now much more thoughtful macro foundations for where those elasticity come from. And it will be a whole paper to really do it well, but and it's in the works. Basically, zeta is fairly invariant to policy. So the elasticities were fairly invariant to policies. Let me not expand too much. Flows, however, can really change with policies. And there's a whole issue of, given we're doing kind of behavioral, in part behavioral economics, we know people respond to incentives, etc., but they may not in a fully rational way, a bit like in Kilian's paper this morning, maybe with some attenuation. Typically, the pattern, there's some attenuation to rational incentive. There's some extra like behavioral noise on top of that. That's the general picture. So how do you do Lucas critique structural model? And basically, I think you can do it, and it would be something like, the flow would be some basic flow that basically the rational incentive dampened with an extra noise, dampened by some form of inattention, probably. And then you have some reaction to policy that you can model, and then typically there's 1 or 2 free parameters, and then you can feed that on data, and then you will have at least in principle, if a policy instrument JT moves around, here's how the behavioral reaction function of those somewhat partially behavioral agents would change, and so you could do things. Anyway, so that's conclusion for policy at the ZLB. When inflation is low, you're close to the ZLB. Do QE for assets that are inelastic, and whose price, and also something I didn't mention, but it should be true, whose price affects investment. So this is, of course, useful only to the extent that the price of stocks will affect investment, and I think there's quite a bit of evidence for that. But and you could do QE for stocks and junk bonds and MBS. Again, it's anathema in the US, but if we're stuck at the ZLB or very close to the ZLB for the next 30 years, it's our duty to try to be inventive and try to find other policies. And almost all the arguments I showed would also work transposed to foreign exchange. Okay, let me not talk about that. So let me just, So just for macroeconomists around here, you might say, okay, how do you establish the causalities in those markets? So that's where this granular IV works. And the idea, okay, you use idiosyncratic shocks to look at the impact. And once you think about it this way, there are lots of sources of identification. So the industry-wide spillovers, a bit like for the industrial policy example. So suppose a firm expands, like Hilton builds lots of new hotels in New York. What will the other firms do? Marriott, et cetera, et cetera. You can lose an idiosyncratic expansion shock from Hilton to look at the impact on the rest of the market for the supply response, and also to look at the price of hotels, hotel rooms to get the elasticity of demand. Likewise, you can look at impact of intermediaries and asset prices and growth spillovers and that sort of thing. And let me just mention, now there's one paper finally in the JP on the basic granular IV. And we're in the works, not yet released, but maybe hopefully soon. You can do the same thing with networks. So you have N by N economy where the steel industry uses this input and that output, and there's a idiosyncratic shock to the car industry is going to demand more steel, so you can say something about demand for steel. But also if there's an idiosyncratic shock for demand for steel, it tells you something, it will change the price of cars. You can also look at the demand for cars, and just with all those idiosyncratic shock, you can, in principle, as a matter of theorem, identify tons and tons and tons of parameters. So I think that's a bit my hope for how to do macro finance with causal linkages using this kind of granular IV. And that may be way too many equations, but suppose you have a model like that where GDP depends on the GDP of growth of the other companies with some parameter gamma. There's a matrix that it depends on elasticity and all that. Maybe it depends on the past. And mostly there are idiosyncratic shocks. There could be aggregate shocks. Then you can, and I have a few examples, but let me not go there. You can in principle identify tons and tons of those parameters using idiosyncratic shocks in one industry, seeing how it ripples to the industries that are customers of that industry, customers that are suppliers to that industry. And something that's kind of nice, now we start having lots of big data sets with lots of industries. Often they have a large N, so a large number of stocks, a large number of industries, large number of firms, but a fairly short panel. And actually Kilian, with my colleague and friend Ludwig Straub, has a paper being presented just with that. So typically you have a short panel, very short time panel, but very large number of firms. But here the typical error is N times T. So even if you have a short panel, given you have many industries or ripple to each other, in principle you can get a very, very high precision. Anyway, so that was a bit of a, part of it is how do we go to do causally identify macrofinance from where we are now. Anyway, so let me close. Just I want to have one plea for the number of you guys are extremely influential in various spheres of the U.S. System and the world. Plea for central bankers. So and other influential people here. Okay. So part of the way this kind of research with supply and demand has been possible is via this Koigen Yogo paper where you look at holdings. And why is that possible is because there are holdings data for stocks that are particularly great, called the 13F data. So all institutions with more than $100 million worth of assets need to show their stock positions. Okay? And it would be fantastic if the firm, say the Fed or some other government agency had access to all the bond positions and FX positions and quasi-FX positions like derivatives and the like. And I think they should have it. Frankly, the cost to firms, everything is digitized. The cost to firms to release that to a firm, to the Fed is minimal, and the impact would be great. So, because if you want to know systemic risk, wherever systemic risk right now, etc., you need to know who holds what assets, who is likely to liquidate if there's a collapse in real estate pricing, etc., etc. And so that's just the totally necessary tool for that. So the Fed really should do that, should force the collection of that. So it needs to have, maybe go through Congress, I don't know. And then you should also release it to academics, maybe a 5-year lag or 1 month lag, I don't know, some lag. And then there will be lots of basic research about to understand what's going on in sort of the macro financial flows. Okay, I'm done. So this is how you can think markets are very inelastic, especially the stock market, and by the way, FX market, so very inelastic. Bond market much more elastic. But so you should do QE a lot via stocks and maybe FX and maybe less via bonds. And hopefully with new data from the central banks, we can make great progress. Thank you very much.
With the interest of time, let's open it up to some questions from the audience. Maybe I'll gather a few questions and then I'll let the speakers answer them.
Hi. Great session. I really enjoyed all three presentations. I have a question for Caroline. I really like this idea of incorporating the stock and bond prices within the sort of simple three equation models and look at this differential between the real and the nominal beta to assess the the risk for the real economy, which is correlated with inflation. My concern, maybe more suggestion or concern, is to incorporate explicitly the fiscal side and fiscal shocks. And the reason is that, I mean, you might think that in your setup, fiscal shocks are basically incorporated in either demand or supply. And maybe you think demand shock traditionally, but it's not that obvious because if you think about government expenditure shocks, traditionally we think of those as being kind of demand shocks. But if you think of the sort of the last episode of big fiscal expansion, there was an expansion in transfers. And if we abstract from Ricardo neutrality, that looks more like perhaps a supply shock, because it would be an increase in inflation, and then transfers could have a negative effect on labor supply, for example, and decrease output. So it would be, I think, very, very useful and even enlightening, I think, especially for the last 10 years or so of data to introduce explicitly fiscal shocks to the exercise.
Take a few more questions, and then we'll let the speakers answer them.
It's really a great presentation. Thank you all. Xavier, a question for you. Are you proposing a Fed-based industrial policy to link it back to the previous...
Asset policy.
But the related question was, you briefly mentioned that in one of your slides. You didn't talk much about the real economy linkage. So if you can raise for 1%, 5% of relevant asset valuation, what is your, maybe you already have estimates of the real economy impact of that. Does the investment go up? How should we think about that again in a general equilibrium context?
Great.
Thanks for the great talks. This is a question for Moritz. So you built this amazing long data set of inflation surprises, and I was wondering if you'd looked at, or if you're planning to look at, other outcomes. The particular one I was interested in is this classic idea by Tobin, goes back a long way, which is that inflation greases the wheels of the labor market. A big inflation boom should, all else equal, raise employment because workers' sticky nominal wages are alleviated. And plausibly, that's part of the story behind the recent inflation surge, the recent employment boom. But it seemed to me that you have exactly the right data set to look at this more generally. And I was wondering if you thought about doing so, or if you had any results there. Thanks.
Okay, let's let the speakers answer.
Yes, so Gianluca, many thanks for the suggestion about fiscal shocks. Fiscal shocks have clearly been important recently. And I would love to incorporate them more explicitly going forward. What I can say so far now is, do bond stock betas, nominal and real, do they speak towards more demand type shocks or supply type shocks in the recent period? And especially with the real bond betas becoming positive, it looks more like a dominance of supply shocks. Now, are these supply shocks labor market, supply chain disruptions, you name it, or, Francesco Bianchi and Melosi have this paper arguing recently that fiscal shocks, especially expectations about insufficient fiscal policy, could look like inflation expectations shock more like supply shocks. Whether that's what's going on, I cannot distinguish. But I think what the bond stock betas can tell you is that to the extent that fiscal shocks have mattered, they have probably acted more like supply shocks. So a little bit, I think even what I already have can tell you a little bit kind of what you're interested in. But I agree, it would be fascinating to figure out, do these fiscal policy shocks have separate effects that distinguish them from the other supply type shocks? But yeah, I completely agree.
Great. Atif asked a fantastically important question, which is, okay, you manipulate you make the stock price of those firms go up, or you make their bond yields go down. What's the impact on investment? So it's a huge question that lots of people have tried to answer, including people in this room. Of course, you need to multiply the impact of the Fed on those asset prices, on those rates, with reactivity of investment to those rates. And there's a variety of opinions, and not opinions, estimates on that. Actually, Kilian's paper this morning was pretty much related to that. Maybe I'll ask my expert friends about that. My sense, maybe if your cost of capital goes up by 1%, what's the best estimate, Kilian and maybe Thomas, for how much does investment go up in? So if the cost of capital is lowered by 1%, how much does total investment to GDP go up? Maybe 0.5% of GDP? I don't know exactly. It would be. Sorry? Okay, we'll run the auction. Something like that. That's an important number to pin down. Right.
Yeah, then let me come in quickly. It's a great suggestion. We've been quite busy getting these data together, and there's lots of implications. Labor market data, I mean, this is macro history week here. Labor market data are a big gap. Cross-country, going back a long time. It's not easy with wages, but even that is sketchy. And then sort of more granular labor market data is, I think it's on the agenda of a few people, but we'll get there. And then many other implications and questions. Yeah, thanks.
So I have a follow-up for Javier on the implications of this for policy. So say you start out with some rules that are on investment funds and so forth on how they can allocate their portfolios. And that gets you started with your elasticities, right? So your starting point is what the investors have in terms of these rules. Then you take the sectors where there's the most price impact, and your idea is to select those for official interventions, quantitative easing, and then that would transmit to a greater investment response. Okay, so following that through, in this kind of proposed implementation of monetary policy, the Fed is going to start with the kind of hedge fund related constraints or fund related constraints, and that is going to lead to selected volatility in particular sectors on investment, and selected volatility, a lot of volatility on particular sectors for jobs. So just a question, how does that play out in terms of the political discussion and central bank independence ultimately?
Right. No, of course. So as I mentioned very quickly, way too quickly, no, the political economic consequences are very hard. So you may want to just do a blanket. So I'm a bit of a limited government kind of person. So despite that, so you want to do something fairly neutral, yeah. So limited version. Well, exactly. Well, I prefer to invest in asset markets rather than do industrial policy, but that's another, let's not go there. So I'm open-minded, actually. So it doesn't matter when my opinions are. But no, so as a matter of theory, you could add extra constraints of not to distort various parts of the economy, and that would lead to potentially a very complicated scheme, but a first-order version of the complicated scheme would be pretty simple. It would be you just buy, some sort of neutral basket of corporate bonds or that sort of thing. Not even though in principle targeting that sector that's particularly crying for investment would be better. You might say at a meta level to avoid the political economy issues, you do a broad fixed basket, so to speak. Yeah.
Go ahead, Wei.
I want to follow up a question on Xavier about your estimate. I think the number you show is a huge, right, 5 or something. So I wonder, in terms of this elasticity, what's the horizon? This issue, right? So how long it lasts?
Yeah,
we know in '87, stock market crashed for no reason, right? So large amount. It's like what you estimate is very inelastic. When somebody start to panic sell, then price will crash, right? But I thought a few months later, eventually climbed back because people realized nothing happened, right? There's no fundamental. So I think sort of this horizon issue here And you know, you mentioned something about you know, mandates. Investment funds, they have mandates. It's difficult for them to go cross, right? If the stock price is too cheap, but I'm bond fund, I cannot do it. But over time, if it lasts for a year or two, you know, a new fund can be created to buy it, right? Because if people recognize it's just too cheap, right? So I'm curious, sort of, your view on this.
Right. Great. Yeah. So the horizon. So we're not at all about the short-term horizon, like day to intraday or a few days. The horizon we have in mind is a few years, if you want. The estimate I showed you is 1 quarter up to a year that the standard deviations become very large. But on calibration grounds, we know that it's very hard to forecast the stock prices, etc. It's think 5-year, maybe 10-year horizon. Maybe it's 20 years horizon. If you persuade the American public that stocks are a great investment for your pension funds, maybe permanently stock market valuations are higher, and permanently PE ratios are higher. It could be very permanent. So that's how I think about it.
So related to the question just now, Xavier, have you looked at variation in the share of pension ownership or fund ownership, or more generally, you know, to what extent different countries' stock markets are owned by funds that have relatively stable guidelines, and that probably affect to a large extent the estimates in your papers. I read them as being basically for the US most recently, but maybe there's some, you know, maybe Moritz has some historical data he can share with you on that. And then a question for Moritz. So you calculated those inflation surprises. I suppose to figure out whether it's really demand or a supply shock, you want to think about the expected, you know, GDP response rather than the realized GDP response, for example. I have no idea how to do this, but is there some way that you could try and figure out other types of expectations rather than inflation surprises? And that would be, I think, super valuable for many other purposes as well. Thank you.
Yes, so Kilian, a great question. So when I said, okay, there's a mandate, it could be a psychological rule. So imagine all funds as institutions disappear are just individuals in the world. Now it could be that this is a bit of a model of an individual who says, I have a target, which is, you know, maybe 60-40, maybe it's a somewhat different target, 60% equities, 40% bonds, and I try to stick to that. And you tell me the stock markets are now a great investment, horrible investment. Look, I don't know if you're right. I just stick to my 60-40. Maybe I'll go to 55-45, but I'll go there. So it could be a metaphor in some sense for that kind of thing. Though it's researchable in principle with fantastic archives. You could imagine what a good, German burger would do in 1900 and a portfolio of this person, etc., and look at to what extent do individuals have these kinds of, rules of thumb as a, fairly stable target.
Yeah, I mean, it's a great suggestion. I think we will have, I mentioned it was a little, what we did here in the paper is a little dirty, and it is so, but I don't have an idea as well to do that. I think as Jonathan said, sort of having these inflation surprises for a longer period is kind of an asset now that, and we'll share the data obviously, that we can look at many more questions that we weren't able before to tease out. I mean, we have Livingston for the US, but that's basically it. And now for cross-country basis, we can certainly do more. Ideas very welcome.
Hi. Question about the inelasticity issue. Is that related to the nature of index funds being so dominant? Is a structural element that caused the inelasticity? Because I was wondering if you compared it now that we have ETFs for Bitcoin, right?
Right.
So it would be interesting to test the inelasticity there, because from what I'm understanding, for example, in supply-demand issues on Bitcoin, there's $40 trillion in our that is controlled by our registered investment advisors in the United States, 40 trillion. And they have no allocation to Bitcoin, or very little. So now with ETFs, you have what, 10, 11 ETFs and growing. And my understanding is they're gonna, if they are convinced to invest, along with some other institutional guys, then they're gonna sock it away for the time being, just to have that allocation. So the supply will diminish in terms of what is tradable. And then, of course, you have the halving issue happening soon with Bitcoin. So I'm just wondering whether it's these structural elements that cause the inelasticity that you are observing, i.e. index funds in the stock market, and maybe you'll find some structural issues in Bitcoin that would also account for inelasticity.
Right. I think the elasticity is not due to those structural elements. I mentioned, mutual funds, rigid mutual funds, because it's something you can observe. But I think it's much deeply rooted into nobody knows what the right allocation to stocks and bonds is over the business cycle. So you may as well stick to some rule like 70-30 or something like that. So I think that's the reason. So it's much more permanent. I think it happened also in 1800 and 1900. I have no data for that, but that seems so very plausible. This kind of fixed rule and low elasticity.
That is because Mike Green from, what is it called, Tier 1 Alpha, is citing your research, but he's relating it a lot to the index.
Right. No. If there's more and more indexation with high, actually, allocation to stocks, yeah, that gives you, that increases the elasticity, but it doesn't, change it altogether. And now, for Bitcoin, suppose you had what would be a terrible rule of fashion if people said, oh, it's part of the investment space, maybe it's 1% or whatever on the investment space. We should be in all asset classes. Let's buy Bitcoin. And then, of course, then the price of Bitcoin can be extraordinarily high for no good reasons whatsoever. And there are some people who have estimated the elasticity of demand for Bitcoin, finding it's much lower even than the 0.2 we have, something more like 0.002. But I don't know how good those estimates are. It's more sort of simple regression. I don't know. Yeah. And that would be consistent with most people not trading the Bitcoins and just a few people madly trading that. That's how you get a very, very low elasticity. Most people do nothing.
Enjoyed all the papers. Xavier, just a few things. One is your papers are related to the segmented markets literature. I'm sure you're familiar with that and has some of the same consequences. Second thing is you don't talk at all about disrupted liquidity in a market where a market is not functioning well. And if you think about where QE type policies have had big effects, think about the MBS market in 2008, think about Mario Draghi, think about the corporate bond market in 2020 when the Fed said they were going to set up a program to buy corporate bonds, and it immediately hit yields without any purchases at all. So that's an issue I think that you're not addressing, which is how well the market is functioning. And finally, I would just comment your numbers on the effects of purchases of bonds. That's a hard question.
Right.
And I have in my AEA presidential address, I kind of review the literature. There's a big literature on this. It's hard. You have to deal with what's anticipated, what's not anticipated. You have to deal with the signaling effects. You have to deal with the market liquidity effects. So it's really hard to figure out what the long-term effect is. The kind of number that at least the Fed comes up with is sort of long-term, the QE programs, which were collectively about $4 trillion, had about a percentage point or 1.5 or something like that on the 10-year, which doesn't sound like much, but if you translate it into federal funds equivalent, it might be 3 or 4, which is a lot of space relative to what the space the Fed had. So I guess my suggestion though is to look more carefully at that. It's a difficult literature trying to figure out what that impact effect is.
Right. Great. So a fantastic question. I mean, all your questions are great. So anyway, the markets don't functioning well, or the cloud, etc. That would be, I don't want to sound too obsessive, but I want to be unified. So that would be some market participants cannot act, etc. So very much like the Bitcoin we talked about. Suppose half of the market participants cannot act anymore, but divide the elasticity by 2, and so make all the parts interventions, the quantity interventions, be more effective by a factor of 2. So that would be a little bit how it might be model in that world. And we have some notes on time varying elasticity. So it looks like, and we have even some empirical evidence I didn't show, that when VIX is very high, etc., the elasticity seems to fall. Consistent a bit with those things. It's too risky, so many participants don't want to kind of trade stocks and bonds. They just stay put. And when you said, oh, the Fed, when the Fed announced the program, immediately prices fell without even doing it. So part of why I started with a simple one-period model, then I did an infinite horizon model. If you announce you're going to have flows in 6 months, or maybe on a contingent basis, if some catastrophes happen, that should have impact now. And what you need for that, you need just a little bit of forward-looking behavior by some market participants. So it's consistent with most market participants are not super forward-looking, and you have a few hedge funds, etc., who they don't give that much elasticity, but they give enough forward-lookingness. I'm using
The size was pretty large.
Right. So I'm using very loose words, but almost everything I'm talking about is been lovingly calibrated with even simple thought experiments. And for the QE, it's very hard to get the QE literature because everything is endogenous, the Fed intervenes, but lots of things are going on at the same time. And we cite those papers, but we don't do our own new analysis. So the kind of thought experiment that kind of convinced me that the elasticity was around that is again a kind of thought experiment, in part talking to the traders. So suppose you say, okay, typical trader, the average maturity is 5 years. A typical, bond funds, the typical maturity is 5 years, but they could hold more or less duration by having more or less high long duration bonds. And now you tell them, the long-term yield is 2 percentage points higher. How much do you tilt your maturity? They might say, I don't know, I go from 5 to 5.5 or 6 years, but not that much because I kind of target my 5. So if you take that as their behavioral rule, then you can work out an elasticity, and that's how you get this elasticity also of around 4. That's why I got more convinced for the true elasticity by this kind of simple reasoning, intuitively talking to a trader, or an imaginary trader sometimes, rather than just looking at these clouds of numbers in the fury of history. Well, I like history too.
Need to stop.
Give him more time.
Yeah.
A question about data. When you when you throw in stock prices, are you using equal weighted indices, or using capital?
Typically, just the aggregate stock market, so valuated, yeah.
So it's valuated.
Valuated, yeah. So like the
it could
S&P
be
or
like,
the
so maybe that's not the best way to do it, because we have the Magnificent Seven now, right? And there's been plenty of work that shows that over the last 2 years, maybe 80% of the market performed poorly,
right.
right? So I would suggest that you take a different approach.
It's a good idea. You could look at lots of different indices and then look at that. That's very, very doable. Yeah.
Okay, so let's stop here. I want to thank the panelists for great discussion and also the audience for excellent questions.
Thank you.